Get ready. This is Crypto Talk with Mike Willis in 3, 2, 1.
Hello and welcome to Crypto Talk. I'm your host, Mike Willis. For those of you who don't know me, I spent 30 years as a trader and portfolio manager on Wall Street. But in 2018, I became a Bitcoiner. Each week, we look at crypto, the markets, and the news that actually matters. Let's get into it. First up, let's pull up the Bitcoin chart and see where we stand for this week. A lot's been happening after going through this crypto winter from 120 some odd thousand. I think we hit 125, 126. We fell 50% all the way down to 60,000, and we jumped 30 to 35%. A nice rally here off the bottom. Everyone got excited. They were starting to think we had legs here. Maybe this is this rally right here, and we don't have to go through this big U-shaped bottom. But in the last week or so, we have pulled back 10%. We've gone from 82,000 down to about 73,000 where we are right now. And I'd like to point out here again, for those of you who've been watching, these two head and shoulder patterns up here virtually mirror what happened in the 2021-2022 crypto winter. And if you look at it, did pull back 70% in that crypto winter. And then we came off the bottom and took our time churning across the bottom. This leg down has been a lot sharper, which normally means a sharper incline. We were having that incline, but now it does look like we're back into more of a slow churn as everybody kind of digests the fact that the legislation at Capitol Hill really just passed a committee. There's a lot of work to do on it, whether or not it's going to pass, et cetera, et cetera. Everybody's has questions at this point. So we're selling the news, and right now we're off a little bit. Now let's zoom in on the 5 key data metrics for the week. In terms of price and market cap, Bitcoin's hovering around 73,000. That's a $1.45 trillion market cap with a T. Still doing excellent, even though we're in the middle of a crypto winter. Daily volume is pretty high. Last 24 hours, 42 billion in volume, which was up double from last week. So we definitely are experiencing more volume as Bitcoin has come off the top of its little near-term rally. And then sats per US dollar is 1,370. And if you remember, there are 100 million sats per Bitcoin. And the reason we like to look at that is at some point we Bitcoiners expect 1-to-1 parity with the dollar per sat. So if you do the math on that, if we hit that number, Bitcoiners are going to be pretty excited about their returns. In terms of money supply, we're just 20 million coins have been minted. We only have 21 total, so there's only about less than 1 million coins to be minted. And sats, the cost per transaction right now on the nearest block is hovering between 1 sat and 3 sats. So that's extremely low friction to do transactions for immediate settlement. That's showing that Bitcoin is definitely working. So that's the Bitcoin picture for this week. And now let's get into the news. In my 30 years of trading, I can tell you the headlines are constantly changing. What you have is an investment strategy that works over the long term. I like to ask, what's your crypto plan? Because most people just don't have one. So keep that in the back of your mind as we look at the news this week. Our first article goes into the fact that the SEC has put on the brakes. So remember last week when I said the SEC was about to drop this tokenization framework? Well, Wall Street just got cold feet. The innovation exemption that was on the table that everyone got excited about last week, it's now delayed. The resistance isn't coming from regulators this time. It's coming from the entrenched financial system that has run Wall Street for the last 200 years. The same people we were told last month were behind it. So looking at the article, it's in Yahoo Finance. The SEC delays crypto stock tokens amid Wall Street pushback. The U.S. Securities and Exchange Commission has postponed its planned innovation exemption for tokenized versions of U.S. stocks, citing concerns from market participants. We called this one. The SEC was ready. It was Wall Street that pumped the brakes. Citing people close to the matter, Bloomberg reported that a draft framework poised for release as early as this week now faces delays as the agency reviews feedback. So this week, this is exactly what we said on the last show. It was ready to go. Then the phone started ringing. You have responses to the SEC's announcement from the industry, and the SEC has obviously received enough feedback that they pumped the brakes and decided we need to slow this down. The exemption aimed to let crypto firms and DeFi platforms trade blockchain-based representations of stocks like Apple and Tesla. So that's 24/7 Apple, 24/7 Tesla on chain. That's what was on the table, immediate settlement. So it promised 24/7 trading, faster settlement, and easier fractionalized ownership while keeping tokens classified as securities. So fractionalized ownership, you can actually own less than one share, and that's a big deal. Immediate settlement, 24/7 on chain. These are all amazing things for TradFi. It's been happening in DeFi world for the last 15 years. Stock exchange officials and industry players reportedly raised alarms over potential liquidity fragmentation. Translation: we don't want competition. That's what liquidity fragmentation means. So critics worry parallel crypto markets could split trading volume from traditional exchanges, harming price discovery and efficiency. All right, so here you got the real issue. The New York Stock Exchange was fine with price discovery from 9:30 to 4 o'clock in the afternoon, but crypto doesn't close. That's the real issue. And also that the NASDAQ and the New York Stock Exchange may not get the same share of the market trading that they're used to. So I think they realize this, and they want to slow this down a little bit. And I think that's what you're seeing happening. So investor protections remain a core issue, especially for third-party tokens issued without company consent, which may lack full voting or dividend rights. So this is a real concern here. I don't believe investor protection is the main reason for this slowdown, but they are mentioning a legit concern, which is that some tokens, they're worried about them being released without the company's consent. Picture Tesla and Apple tokens being sold in the digital market that don't have voter rights. And certainly that would be a concern. I don't know anybody that was doing that or planning to do that, but that is a legitimate concern. So tokenized real-world assets is what they're calling this, RWAs. They've surged to over $34 billion according to this article, up 1,600% in 2 years. That's a deceptive number. I'll show you in a minute. With tokenized equities alone exceeding $1 billion in market value. Going down a little further here. So the RWA market really doesn't exist in any organized fashion yet. So this 34 billion assessment is a little deceptive. And if you go over to stowmarket.com, it lists all the real world assets, tokenized real world assets. And this fund it mentions the BlackRock Institutional Digital Liquidity Fund. It's at the top here at 1.2 billion. 1.2 billion. Yeah, I don't know why this is ahead of Hashnote's US yield coin. Yeah, I'm lining that up rightly. They're both in the billions. Okay. But if you look over here in the article, it says that Ethereum leads platforms followed by Solana. BlackRock's BUIDL fund and similar products demonstrate strong institutional interest in on-chain assets. I can tell you this BlackRock fund, it's just a money market fund that's just been sitting there doing nothing. I watched it come onto the chain at Securitize a long time ago, and nobody's really using it. So this mention in the article, whereas it's factual, it's really not a market that's being used, and it's certainly not organic. It's a stale market that's just sitting there, and there's no volume over there if you look at the volume over on stomarket.com. So under SEC Chairman Paul Atkins, the agency had consulted hundreds of participants to balance innovation with safeguards. So this delay reflects caution even in a more crypto-friendly regulatory environment. The SEC is pro-crypto, but they got hundreds of responses, and so they want to sift through them. No new timeline has been announced, but the framework remains under active review. A refined version could still advance later this year, potentially reshaping U.S. equity trading. It's not dead, it's delayed. There's a difference. It's still coming, but there may be some changes in it when we see the final version. I think it just gives the status quo, the TradFiers, time to react so they don't lose too much market share when this all happens. So this pause highlights the tension between ongoing crypto innovation and established market stability, key dynamics for anyone exposed to equities or digital assets. So the old guard is still fighting this. Again, I think we can count on this happening, just not tomorrow. Let's go to Article 2. This one's regarding an announcement that XRP made, and it's a pretty interesting announcement. A new amendment proposal submitted to the XRP Ledger Foundation's repository on May 26 would fundamentally redesign how liquidity pools function on XRP Ledger, introducing multiple curve types, concentrated liquidity, and a future fully programmable AMM architecture that mirrors the most advanced decentralized exchange infrastructure currently operating on Ethereum. So the reason I'm even pointing out this article is everybody, for whatever reason, you add yield onto something and everyone gets excited. So I don't know why that is, because when you add yield on something, you're typically giving up upside, or you're giving up, somebody's actually lending out your shares to somebody else and you're taking on added risk for just a few 100 basis points. So for me, when I lost my first net worth using leverage. And when some of these digital exchanges blew up a couple years ago, the people that got hurt the most were in those lend programs where your crypto was not being actually held by the exchange in your name. It was actually loaned out to who knows where, some Ponzi scheme somewhere that only was going to work and pay your yield if crypto went up. But when it all went down and these pools were all invested in crypto, you didn't get not only did you not get your land interest, but you didn't get your principal back. So lending has never got me excited, but XRP and Ethereum are kind of fighting for this market share, because it is, every time you mention yield, people just love it and it's not going away. But in general, I'm not a fan. All right, article number 3. People always love to talk about Bitcoin whales, so I just thought I'd throw this in here for fun. Mystery Bitcoin whale dumps $1.3 billion in BlackRock's IBIT as the market barely blinks. So a large unidentified holder sold roughly $1.3 billion worth of BlackRock's spot Bitcoin ETF through a dark pool on Tuesday morning. A dark pool. That always sounds good. In what ETF analysts described as an unusually large block trade, the sale stood out not only because of its size, but because the market appeared to digest it with little visible disruption. That's the reason I'm singling this out. Not only is it fun to talk about what whales are doing, but here, one whale dumped $1.3 billion into the market, and the market really didn't move. And if you remember last week, we talked about how Michael Saylor bought a couple $1 billion worth, and a bunch of people out there are saying he's controlling the market, he's moving the market, he is the market. And we just went over metrics that showed you the last 24 hours, there were $42 billion worth of Bitcoin traded. So 1 billion here, 2 billion there is not the market. This is a single day's volume, $42 billion. But anyway, this whale dumped $1.3 billion for who knows what reason. but it barely moved the market. So I think it's worth showing that Bitcoin has matured to the point where it can handle massive trades like this. All right, let's go to our final article here. Kraken now lets you earn yield on Bitcoin holdings via lending vaults. Again, bringing up the lending issue. Kraken users can now earn yield from their Bitcoin holdings via the exchange's new Bitcoin vaults. Putting Bitcoin in vaults earns up to 2.5% APY in Bitcoin rewards. Withdrawals are subject to a 5-day processing and return wait. Sounds like they're not actually being held in your account if you have to wait 5 days. Bitcoin holders can now generate yield on the Bitcoin they hold on centralized exchange Kraken. Exchange users can lock their funds in the exchange's new Bitcoin vault, which allows them to earn up to 2.5% in Bitcoin denominated rewards. So you're getting Bitcoin rewards that accrue automatically to their Kraken accounts. Okay, so if you're getting Bitcoin rewards, hey, you must be fine because it's Bitcoin, right? So must be safe. Many Bitcoin holders on Kraken have made it clear they want simple ways to earn on Bitcoin they already plan to hold. And Kraken Earn and Trade Director said this in a statement. Bitcoin Vault is built for that mindset. It gives customers a way to earn rewards on their Bitcoin through an experience that is easy to access and grounded in trust Kraken has built over time. I would have to read the fine print here, but I don't know a way they can offer you a yield without either loaning out your shares or putting it at risk in some fashion or another. So in my mind, I'm still not a fan of taking yield on my crypto. Bitcoin is going to do what it does, and it's doing it faster than any other asset class in the last 10 years. So I think I don't have to earn a 2.5% extra if it's going to be added risk on the portfolio. Now, believe me, I've had people tell me, look, if you stake, there's no extra risk involved. I just don't buy it. I think in the fine print somewhere, you're loaning those shares out. They're being hypothecated by somebody, or some way it's out of your wallet for a certain amount of time for somebody else's use. And I don't need that for a couple extra 100 basis points. All right. So those are the stories on my radar for this week. Now let's go into the numbers. The reason I look at TradFi versus DeFi is that anything happening in the traditional markets will still influence crypto. So let's pull up the S&P 500 and get a read on what's happening in the traditional markets. I like to compare the S&P 500 side by side with Bitcoin so you guys can see what's really happening here. In the last week, the S&P was up 1%. The last month, up 5%. Last year, up 28%. It's just been on a tearing up the street and looking great. On a 3-year basis, up 23%. Bitcoin, on the other hand, down 3.5% for the week, down 2.5% for the month, down 32% for the year. And the reason I'm showing you this is this. If you're holding crypto right now, and all Bitcoin, you're down 32% in the last 12 months. Your friends who own the S&P 500 are sitting in stocks or smiling and dialing while you're down here sweating bullets down 32%. And if you're in some of the other top 10 cryptos not named Bitcoin, you're down more than this 32%. So the spread between a plus 28% portfolio, TradFi, down 32%, crypto, that's a 60% spread. That's a big deal if you got $1 million or 500,000 or even 100,000 or even 10,000 bucks. So keep it in mind when we're looking at this. But the long picture still, if you look at Bitcoin up 67% and on a 3-year basis, S&P up 23%. So there's a reason we're all in crypto, but just make sure you sprinkle a little TradFi in there to lower the volatility. All right, so that's the macro picture for this week. Let's wrap it up. So 30 years on Wall Street has taught me a lot of things. Here's what this week reminded me of. Wall Street just delayed a framework that would have let anyone trade stocks 24 hours a day, 7 days a week. They delayed it because the incumbents got nervous. Think about this. Buying and selling Apple computer stock, Tesla stock, 24/7 on a fractionalized basis, immediate settlement. These things are all features that Bitcoin has been trading 24 hours a day, 7 days a week for 15 years. Nobody could delay it. There's no committee, no board, no institution that can pick up the phone and slow it down. And that's the whole point. So the reason this tokenization story matters, because it shows you exactly what happens when you try to build decentralized infrastructure on top of centralized institutions. Someone always has a hand on the brake, and they're ready on a moment's notice to change the fine print. So watch for that. Bitcoin was built so nobody has a hand on the brake, ever. And we're still early. So join the swarm. And on that note, we are wrapped for this week. I'm Mike Willis, and remember to keep one eye on Wall Street and two on crypto.
That's Crypto Talk with Mike Willis. We'll see you next time.